Welcome to another session on CL4 corporate law. On the previous occasion, I discussed about the law on the corporate sector in Sri Lanka as well as the various types of companies that can be incorporated under the prevailing law, company law of Sri Lanka. So I think we stop at this slide where we discuss about company incorporation, and I was mentioning that there are mainly four types of companies that can be created, such as the private companies, public companies, then guarantee companies and the community interest companies. So today I would like to talk about the nature of liability. This is a very important aspect of corporate law. That is because liability of the shareholders, or what we call the members of a company, is a very important element as far as the corporate law is concerned. The main intention of creating companies was to provide the opportunity of limiting the liability of the members or the shareholders who are creating such companies. I explained to you on the previous occasion that when the law came to Sri Lanka from United Kingdom at the very early stage, the liability was meant to be unlimited on the members. This was pretty much the same as with partnerships that I explained also the other day. The difference between a partnership and a company is that a company can limit its liability, although there are some other type of partnerships that are limited in fact. But however, when it comes to a company, we know that a company is a separate and distinct legal person outside its members. But however, this particular company can have the members who basically are the human beings, the human element of that company, who can really limit their liability so that their private property or assets do not become subject to any type of disposition in the case of a liquidation, winding up or dissolve of a company. This is the very important element in corporate law, where the members of the company can limit their liability in certain ways. So limited liability companies are created with that intention. But however, there are another set of companies that are unlimited as well. So we should not confuse as to the fact that every company is limited in liability for its members. There is a set of companies that may be with unlimited liability on its shareholders or members. So let me first of all clarify what is this limited liability all about. Under section 3(1) subsection A of the Companies Act number 7 of 2007, a company that issues shares, the holder of which have the liability to contribute to the assets of the company, if any, specified in the company's article as attaching to those shares. Which means that when a company is formed as a limited liability company, the shareholders' liability is limited to the amount of shares that the particular shareholder obtains from that particular company. When we say that it is limited to the number of shares, always a share has a value. It can be like, for example, 10 rupees a share or 50 rupees a share, whatever that from the constitution of the company the shareholders have subscribed. So the share value gives the limitation, whereas in the case of a winding up or closure of a company, then what the shareholder has to contribute is the share value that the particular shareholder has subscribed based on the number of shares that he or she has obtained from the company. Now that particular number of shares will determine the value of the liability that that particular shareholder will have to contribute at the time of a closure. Generally, when a shareholder subscribes shares at the initial point or thereafter during the existence of a company, the particular shareholder pay for the number of shares that he or she subscribed in the company. There is also situations where, with regard to particular type of shares, that the share value is not provided by way of a payment at inception of the company or during its existence. But however, the number of shares that the shareholder has subscribed to has to be supplied even before the closure of the company, so that the company is assured that the particular shareholder would contribute to the number of shares, or rather the value of those shares that he or she has subscribed in the company. It is to that particular value that the shareholder is liable. So the shareholder has to either forsake his or her shareholding at the time of a closure, so that if the company does not have any remaining assets at the time of a closure, then that particular share value is spent by the shareholder towards the settlement of the accounts of the company. In case if the company has made profit at the time of closure, then of course that particular shareholder can reobtain by way of the portion of assets based on the share value that particular shareholder will have at the time of such closure. When a company becomes liable to its creditors, then at that particular moment the share value of a certain shareholder has to be contributed towards the company to set off those liabilities. And the limitation of that share value is the shareholder's liability towards the company. So this is basically the limited liability area. For example, when a company is named as ABC Limited, then we know that the particular ABC company is a limited shareholding company, where the shareholders' liabilities are limited. So, when you look at the style of a company like ABC Limited, then we can see that it is a public company. If it is a ABC Private Limited, that means it is a private limited liability company that has been created. If it is a ABC Public Listed or Public Quoted Company, then it is a public listed company which is limited by shares. So, likewise, the limitation of liability exists in such companies, whether it is public or private or listed. The other type of liability is where the liability of the shareholders are unlimited. If the company has been formed as an entity that shareholders' liability is unlimited, then the shareholders have to contribute unlimitedly. Due to the fact that the liability is unlimited and that the shareholder will have to contribute his personal assets in case the company becomes liable, this sort of structure is very rare among the companies. But you can't say that there are no unlimited companies, there are, but it is very rare that we find such unlimited companies. So, section 3(1)(b) of the Companies Act provides that a company that issues shares, the holder of which have the unlimited liability to contribute to the assets of the company under its articles, is known as a unlimited liability company. So, when there is a situation like that, the company name and the style would be like, for example, ABC Unlimited in the case of a public company and ABC Private Unlimited in case of a private company. Now, looking at these phrases or styles, you can see that these types of unlimited companies are very rare in our country, and we hardly see the incorporation of such a company nowadays. That is because no one would want to contribute their own personal assets at the time of a liability issue of the company, because that would be a complete loss for the shareholder. That is why the limited liability companies are much popular among the shareholders or members of a company, and most of the companies are created with limited liability. The third category of liability is the guarantee liability. What do you mean by guarantee liability? It is where the shareholders or the members provides a guarantee at the time of any closure or winding up of a company, that when there is a liability, of course, at the time of such closure, the shareholders undertake by promise that they would contribute towards the loss. The loss in the sense, it is also based on the number of shares that they would guarantee at the inception or during the existence of the company. That means that at the inception they might undertake that they would be contributing towards the number of shares, or in the case of an unlimited liability, they would be unlimitedly becoming liable due to the guarantee that they have given at the inception, or even during the existence of the company. If more shares are subscribed by a particular shareholder, then at the time of such closure, the particular shareholder or shareholders have to provide the shareholding or the value in accordance with the guarantee that they have given. So the liabilities are of three folds. An example I have given with regard to guarantee is where in such a entity they use the name and style such as ABC within brackets Guarantee Limited, or as a public company, or ABC Guarantee Private Limited, or even ABC Guarantee Unlimited, whatever. Now we have seen such companies in Sri Lanka also, where such guarantee companies exist with the name and style, and in between they put the bracket to say that it's a guarantee company. By that we have to understand that the shareholders of such companies have guaranteed to meet the liability either limitedly or unlimitedly based on their commitment and undertaking that they have given at the very inception of the company or during its existence. Next, I would like to explain to you or y'all that the liability, as I mentioned to you before, is based on the shares. The number of shares that a particular member or a shareholder subscribe. So, if a particular shareholder subscribe, for example, 10 shares in that company, his or her liability would be limited to that 10 shares. So, the liability of the shareholder is limited to the number of shares that the particular shareholder subscribe in that particular company. Now, if you look at this case law, British case law, Boland's Trustees versus Steele, Farwell Judge has stated that a share is the interest of a shareholder. That is because the shareholder subscribe to the share in the company. It is not that the shareholder subscribe to the company, but he, by way of obtaining the share, subscribe to that particular share. And in the company, measured by sum of money for the purposes of liability in the first place and the interest in the second, but also consisting of series of mutual covenants entered into by all the shareholders. So, by subscribing to a share, the shareholder will declare his liability, that he would be liable for the number of shares that he or she would take or subscribe, and that particular number of shares will have the share value, the amount in rupees that the particular shareholder is liable towards the company. It also may be the interest that the shareholder has if the company has profits or assets, where then the shareholder has the interest towards that assets or property based on the value of the shareholding. It could be percentage or it could be number of shares. I mean, the percentage would depend on the number of shares. As per section 49(1) of the Companies Act number 7 of 2007, a share in a company shall be movable property. Now, this is a very important element. We know that there are mainly two types of properties existing in the world. One type is immovable property. Other type is movable property. Now, immovable property in the sense, like for example, a land or a building is an immovable property. And also electricity supply is also immovable because it is fixed to an immovable property. Therefore, electricity is also immovable. If you look at money, if you look at this computer, these are movable properties. You can move this property. So likewise, share is a movable property. What is the significance of being movable? The share can be transferred by sale by one shareholder to a new shareholder. So that is why a share becomes a movable property. The shares or the other interest of a member in a company are personal property as well. Now, beyond the fact that a share is an immovable property, it also becomes a personal property for the holder of such shares or the shareholder. As long as the shareholder holds that share, it becomes his personal property. When he transfers that particular share to another person, then that becomes a personal property of the new person who holds that share, or the transferee we say. So this personal property can be transferred from one person to another. So when a share is transferred, it becomes a personal property of the transferee. Under section 49(2), subject to the company's articles, a share in a company shall confer the holder the right to one vote on a poll at a meeting of the company on any resolution, the right to an equal share in dividends paid by the company, the right to an equal share in the distribution of the surplus assets of the company on liquidation. So when a particular shareholder holds a share, it is, or rather it provides one vote for him or her. Now suppose that a shareholder has 100 shares, each share will have one vote, and the 100 shares will give that particular shareholder 100 votes. There are no fractions in this share. It is based on a full number, which is 1. So one share provides one vote for a shareholder that he can cast or use in a members meeting in order to rely upon a certain decision that the members take within the company. And also the share gives an entitlement for the dividend, which is basically declared at the end of every financial year. So end of every financial year, based on the dividends are of course based on the number of shares that the particular shareholder holds. And generally the dividend is declared on a share. So if a person has 100 shares, that particular portion of the dividend will be multiplied to 100 by 100 to see what's the accumulated dividend that the particular shareholder will have from the company. And also, in case of a asset remaining for a company at the end of a closure or winding up or dissolving, then the shareholder will have an equal share on that asset. Suppose that there is 100,000 rupees remaining as assets in the company, then if there are 5 shareholders, it would be with say 1000 shares, then 100,000 will be divided into 1000 and see what each share will allow such shareholder to obtain as part of the asset. Section 49(5) of the Companies Act states that a share in a company is transferable in the manner provided for by articles, and such articles may limit or restrict the extent to which share is transferable. Now, I told you that a share is transferable. Generally, how shares can be transferred need to be mentioned in the constitution or rather the articles of association. And also the articles of association may sometimes restrict the transferring of shares. This is mainly due to the fact that company members or shareholders are the main decision makers of the company. The decision making powers of course have been delegated to the board of directors who run the management and administration of the company on a daily basis, but the final decision remains with a shareholder. In case that a particular shareholder comes into a company and that particular shareholder is not favorable for the rest of the shareholders, then by constitution or the articles of association, the company can restrict transferring of shares to such a person, so that the holder of shares will not be eligible to transfer his or her share to an unwanted person. So, that is the real purpose of bringing this restriction in the articles of association or in the constitution of the company. So, this has been allowed by law, as you see. Under section 50, immediately following the incorporation of a company, the company shall issue to each shareholder named in the application for incorporation the shares to which that person is entitled. So that at the initial point, the real shareholders of the company will be disclosed and their names will be listed, and it is important, necessary to provide the names of the shareholders to the Register of Companies in the respective documents or forms maintained at the ROC. Each time a share is transferred to somebody else, then such share transfer needs to be deposited with the ROC as well, so that the Register of Companies will know and also will maintain the records, so that anybody can see who are the shareholders of this company. If two or more companies are amalgamated, in case where company A and company B is amalgamated into one and a new company is created, like AB or with a different name like C, then in this particular amalgamation, section 5.2 states that immediately following the issue of a certificate of amalgamation, the amalgamated company shall issue to each person who is entitled to shares under the amalgamation proposal the shares which that person is entitled. So when two companies or more amalgamated, then in that case we need to consider that it is a new company that exists because it is amalgamated. In such a case also, it is necessary that this new company or the amalgamated company rather have to inform the ROC what is the shareholding of this amalgamated company and what amount or numbers of shares that are being allocated or given to each of the shareholders who are remaining in the amalgamated company. Subject to the said, the company's articles, the board of a company may issue such shares to such persons as it considers appropriate. So subject to those conditions, the new shareholding can be declared. The board shall approve terms of issues which will set out the rights and obligations attached to those shares as well. So when the shares are so allocated to the members, the board will take the cognizance of what sort of rights and liabilities that each of those shareholders will have in such case. When there is a share transfer or due to an amalgamation, there is a new scenario of acquiring shares of the amalgamated company. However, issuance of shares shall be consistent with articles of a company, because the articles of association is the main constitution of the company, and the articles must declare how the shares are allocated and how can that take place, and to the extent that they are not inconsistent and invalid and have of no effect to the articles and are deemed to form part of the articles and may be amended in accordance with rules relating to amendment of articles or the constitution. As per section 51(4), within 20 working days of the issue of shares after incorporation of the company shall give notice to the registrar in the prescribed form the number of shares issued from the company, the amount of the consideration for which the shares have been issued, what we call the share value of each and every share or its value as determined by the board under subsection 2 of section 58, and the amount of the company's stated capital following the issue of shares. So with the issuance of the shares, what the company obtains is the capital. The capital consists of the shares that have been given to the shareholders. When issuing shares by the board shall decide the consideration for which the shares will be issued. Now, consideration in the sense that a company may commence its business upon incorporation with a minimum share value such as, for example, 10 rupees a share. When the company does business and grow and creates profits, the share value of the company also grow because the company is profitable. In case further shares are to be sold, seeking the inflow of revenue for the company by way of distributing shares of that company, then in that case the board can decide what sort of a share value that the new shares will carry. So the value of 10 rupee a share at inception may grow to like 50 rupees or 100 rupees or even more per share at the time of such sale of the share. So the board of directors can decide, and whoever who subscribe will decide to buy the shares or subscribe to the new shares if the company is doing well. Because we know that nobody will invest in a company that is sinking or the company that is running losses. But suppose that a company running losses is to be acquired by somebody else, thinking and anticipating much better business under a new administration, then they might even buy the shares at a lower price. Like for example, the 10 rupee share might have dropped by then 5 rupees per share, and would acquire, the new shareholders would acquire such shares at a reduced rate. And also the board will resolve that in its opinion that the consideration is fair and reasonable to the company and to all existing shareholders. So the board has to make sure that the share that they offer has a reasonable figure, and also it is fair value. Now generally, how to determine the fair and reasonable figure at the time of selling a share? That it cannot be too low or too high. That always the board will decide based on the solvency of the company, how profitable the company is, or how loss that the company has sustained, what sort of a loss based on either of these things. So therefore we say that in such a situation the fair and reasonable value of a share is generally the market value of that share of the company that can be offered to anyone who is interested to subscribe that share. So being fair and reasonable will also depend on the company's performance and what the market value for that particular share in the company. The consideration for which a share is issued may take any form. That the consideration could be either in terms of money, like currency, or in terms of assets. Sometimes a new shareholder might say, I do not want to invest in currency, but I would like to invest by my asset. And then you value the asset, put to the company, and for that particular value, the company issue the number of shares based on the base value at market rate. It could be cash, promissory notes even. Promissory notes is not ready cash, it is a undertaking or a guarantee that a person gives that the money would be paid on demand. If the company demands, at that time of demanding, the subscriber of the shares has to pay. So in such a situation, a promissory note can be given, and that promissory note, like a check, is valuable. If the subscriber doesn't pay, if it is demanded, then the subscriber can be sued to obtain that money. Or even future services, that some expert person might say, I would like to join the company as a shareholder, but I would not invest in cash or in terms of money, but I will provide my expertise, and that expertise need to be valued and allocate the number of shares to that expert. It could be even the property, as I told you, of any kind, or other securities of the company. It can be also other securities that is provided to a company. Now when you say other security, for example, let me say that if a company needs to obtain a loan from a bank, a third party person who has a property might say, okay, I will provide my property as a security to the bank loan. But during the time that the loan, or rather the mortgage, is intact to that property as a security, I would require number of shares from the company to the value of such security. Upon receipt of the consideration, the company shall within a period of 20 days make an allotment of the share. So the share allotment distribution has to be made within 20 days from the date of providing such consideration, the value. Now let me discuss what is a share. We have been right throughout talking about this particular word, because that is the basic element in a company, shareholding. The members of the company become shareholders, as you now know, by virtue of subscribing to shares. So let us see what is a share. Though the Act does not provide definition to the term share, a share is part of the capital of the company. It is part of the capital. That is the initial investment that is there in the company. In any company, the initial investment of that company is the capital. The capital can grow, and always it grows with the shares. So therefore, share is a part of the capital. As per section 58, the stated capital in relation to a company means the total of all amounts received by the company or due and payable to the company. As I told you, it is not always the paid up sum which forms the capital. It may also be the non-paid but anticipating payment that the company value considered as a part of the capital. So, the stated capital in relation to a company means the total of all amounts received by the company or due and payable to the company in respect of the issue of shares and in respect of calls on shares. That means the shares that have not been paid or settled already, but where the shareholders have taken the shares without providing the payment, but where the company anticipate payment so that the company can call the shareholders to settle the share value against the number of shares that the particular shareholder has subscribed to. Where a share is issued for consideration other than cash, we know that a share can be purchased on a non-monetary term. So, where a share is issued for consideration other than cash, the board shall determine the cash value of such consideration. Now, this is what I have been telling, like valuing the property, valuing the asset for that purpose, and where a share has attached to it an obligation other than an obligation to pay calls, and that obligation is performed by the shareholder, the board shall determine the cash value, if any, of that performance, and the cash value of that performance shall be deemed to be a call which has been paid on the share for that purpose. So, in case a property has been kept as a consideration for the share, and at a time that the company is dissolved, then the company can call for the encashing of that property, so that that particular payment or the asset will become like a call of shares and consisting as a share that remains in the company. Shares and stocks in a company differ slightly. Now, you may have heard this word shares and stocks, and you may have confusion as to its similarity or difference. Something that the term share and stock are same, and something that the term share and stock are different. Shares and stocks in a company differ slightly, as a stock is a security issued by a company. Security issued by a company that represents an ownership right, where the particular stockholder will have a share of ownership to the company, share of ownership to the company, ownership right in the assets of the company, and a right to a proportionate share of profits after payment of corporate liabilities and obligations. So, the stock will ensure the entitlement of a portion of the assets of the company, and that provides an ownership right to the company assets. So, this is the difference between a share and a stock. A share is the smallest unit into which the company's capital is divided, as you now know, and representing the ownership of the shareholders. Shareholders, by virtue of holding shares in the company, are the virtual owners of a company. They are the real owners. A stock, on the other hand, is collection of shares of a member that are fully paid up, such as providing a property towards the company and securing the ownership right of the company. So, this is basically the difference between share and stock and how they operate side by side. Now, let us look at who is a shareholder. Now, this term also I have been telling repeatedly again and again in our lectures. Who is a shareholder? The shareholders are members of the company. They are the real humans that are operating in the company and the virtual owners of the company and are the owners of it. When shares are transformed into stock at a certain juncture, when the shares are turned into stocks that provides ownership right to the assets of the company, then the shareholder becomes a stockholder. Otherwise, not every shareholder becomes a stockholder. A shareholder becomes a stockholder when he or she obtains a stock in the company, the ownership right. That particular stockholder who possesses same right with respect to the dividends, so that the stockholder is also entitled for the dividend that is declared at the end of each financial year as a shareholder possesses. So, likewise a shareholder, a stockholder, even though he is a bit more than a shareholder who has ownership rights to the assets of a company, will also be eligible to obtain the dividends at the end of each financial year. According to section 86, where shareholder is defined in our law, it means that a shareholder is a person whose name is entered in the share register as the holder for the time being of one or more shares in the company. The shareholder can own the share at the inception or in the continuance of the company. And when a share is subscribed, then he becomes the owner of the share for that particular time until he or she sell the or transfer or gift whatever or create a trust whatever to another shareholder. Also, he is a shareholder until a person's name is entered in the share register. So, until the new person's name is registered in the shareholding register, in the ROC, in the company, and also tendered to ROC as a proof, then shareholder remains until a new shareholder is replaced for his disposition of the share to that new person. A person named as a shareholder in an application for incorporation of a company at the time of registration of the company also is considered the shareholder of the company. And until a person's name is entered in the share register, a person who is entitled to have that person's name entered in the register under a registered amalgamation proposal as a shareholder in an amalgamated company, it is the same manner. And until a person's name is entered in the share register, a person to whom a share has been transferred and whose name ought to be but has not been entered in the register is also a shareholder. Now, in case that the new shareholder's name has not been entered in the shareholder, by virtue of subscribing that share, whether or not his name is in the register, that new person will remain as a shareholder, because we say that he holds that share either having paid the money, although his name is not entered in the register, or where he has paid the money but not entered, and he also holds a trust as a beneficiary that he is entitled to be a shareholder in the company. So that is why, whether the name is entered or not, that person can still be considered a shareholder, because of the fact that that particular person has paid or settled or has subscribed to the share, giving commitment for future settlement of that share. So likewise, I showed to you in this in this definition, a shareholder would mean any of these, belonging to any of these three categories, A, B, C. In case of a trust that has been entered in the share register, the person whose benefit those shares are held in trust. Now, let me clarify here what is a trust. A trust is a kind of an instrument that has been created, whereas when certain money has been invested in a company by way of shares, then in the name of maybe another third party, that third party becomes the beneficiary to the shares. The trust may have been created, for example, by the father of a child, making that particular child the beneficiary. But since the child is underage, the father would make someone as a trustee who would hold that trust for the benefit of his child. In such a situation, when a trust has been created for a certain number of shares, the trustee of those shares will have to make sure that the benefits of the trust shares are utilized in the proper manner for the benefit of the beneficiary. So that in that case, a trust has been created and entered in the share register that certain number of shares are held in trust, and that particular trust, whose benefit should go to the beneficiary, the company would be holding that trust for the benefit of that beneficiary. Then it shall be deemed to be a shareholder in the company. So that trust is deemed to be a shareholder, because that child cannot be a shareholder, but the trust can. Obviously, the trust will have a trustee, and the trustee will make sure that the benefits of the shareholding will pass on to the beneficiary. until the child becomes the proper age or for a certain period that the trust has been created. Then the trustee has to make sure that the shareholding is properly managed. And the company, on the other hand, has to make sure that the vested shares by way of a trust are properly held by the company for the benefit of the beneficiary. So, in that case, and shall in respect of those shares enjoy all such rights and privileges and subject to duties and liabilities until his name appears as a shareholder in trust. So that the trust has to be a shareholder, then that particular trust has to make sure that the proper duties and liabilities as a shareholder are executed properly, and all what the trust does is for the benefit of that beneficiary. Where a company has wrongfully failed to enter the share register, in case a company has wrongfully failed to enter in the share register the name of a person whom shares have been transferred, if the proper shareholder's name has not been entered, that person shall be deemed to be a shareholder in the company, because it is the company's fault that the company has wrongfully failed to insert the name of the person as a shareholder. So, for that, the particular shareholder cannot be victimized. So, the company has to make sure and honor that particular person is the shareholder of the company. If his name is not being entered or wrongfully failed to be entered in the share register, and shall in respect of those shares enjoy all such rights and privileges and be subject to duties and liabilities as a shareholder as well. So, if his name is not there, even he is a shareholder, and also he or she will have to carry not only the rights and privileges, but also the duties and liabilities as a shareholder. Now, let us look at the different categories of shareholding, because you may have heard of various types of shareholdings in a company, what the shareholders can subscribe. One basic type of shareholding is called the ordinary shares, ordinary shares of a company. That is the most basic type of shares in a company. It is the most ordinary type that carry one vote per share, are entitled to participate equally in dividends. This I have taught you all. And if the company is wound up, share in the proceeds of the company's assets after all the debts have been paid can be attained. If there is any liability, then you have to give up that share against that liability. There can also be non-voting shares among the ordinary shares. Generally, ordinary shares are voting shares, but there also can be non-voting shares if the articles of association or the company constitution provides so. There can also be non-voting shares that carry no rights to vote and usually no right to attend general meetings either. Such shares are widely used to issue to employees. Like I told you last time, that some companies provide or give shares to their employees, and in such a situation, such ordinary shares belong to a different category. The category is non-voting. Even though they are ordinary shareholders who have a right in the company, they do not have right to participate in company meetings or vote at company meetings. Such shares are widely used to issue to employees so that some of their remuneration can be paid as dividends. So that part of the remuneration that particular employee earn could be provided from the dividends at the end of a financial year in that company, which can be more tax efficient because it would not be subjected to a tax system such as the payee tax, pay as you earn. It may only be like taxable for VAT. So there is some tax advantage there, not to contribute that dividend towards payee for the company and also for the employee. Now, as per section 49(3) of the Companies Act, company may issue different classes of shares other than ordinary shares, and in particular may issue shares which, number one, that are redeemable, or confer preferential rights with a share to distributions, or confer special, limited or conditional voting rights, or confer no voting rights. So apart from ordinary shares, there are also some other types of shares such as redeemable shares. Redeem against certain things, or some preferential votes. Preferential rights are given, what we call preferential shares. Generally, preferential shares are given to high caliber people or business tycoons in order to get them into that company. So they are given some preference to be part of that company. So preferential shares are given, and also there are sometimes other forms of shares with special entitlement, privilege, but with some limited or conditional voting rights, or confer no voting rights at all. So let us now look at these different types of shares. The redeemable shares. Shares issued on terms that the company will or may buy them back at some future date. It's redeemable. You give it, you take it. So you have the company has a right to always obtain the shares back. Now in ordinary shares, there is no such right for the company. When the company gives shares, it's gone. But redeemable shares, of course, are given on the condition that when the company requires it back, the company can pay and get that shares back. So the company will issue the redeemable shares at a certain share value, and when the company wants to take back that shares, the company can do so by settling the particular share value at a future date. The date may be fixed. That means, for example, that the shares will be redeemed in 5 years after they are issued, or at the director's discretion, where the board of directors may at some time take a decision to reobtain the shares that fall within the category of redeemable shares. The redemption price is often the same as the issue price. Now that is very interesting. There is no market value attached at that time. The redemption value is the same as the value that at the time of issuing of the share, but need not be always. It can be either pre-stated at the time of issuing the redeemable shares, that when the company wants to buy back, this is the figure. Like for example, it can say, the company can say, the redeemable shares will be bought back at the same value as it was issued, like 10 rupees a share. Or else at the time of issuance of a redeemable share, the company may say, we will take back the share, but at any time that we are taking that back, we will be paying 50 rupees a share. Or else, at the board discretion, they can fix even a higher figure, or whatever the figure that they consider beyond the value of the initial share. Generally, it is redeemed at the initial figure, but it may vary depending on such circumstance. Often done with non-voting shares given to employees, so that if the employees leave the company, his or her share can be taken back at their nominal value. So, this kind of a redeemable share could be like a security for an employee, that the employee's employment is secured in that company. So, redeemable share is given to an employee, so that the employee also feel that I am working for my own company. Now, this is a very good attitude. It increases the morale of an employee when he or she feels that this is my business. But however, when a redeemable share is given to an employee, it could be also on the condition that you return back the share when you leave. So, during the time that the particular employee is working, the employee can be happy that I am working for my own organization. So, redeemable shares are given to employees to encourage and boost the morale of the employee, so that the employee works for that company as if he is a part of it. There are statutory restrictions on the redemption of shares as well. The law has introduced certain statutory restrictions on redeemable shares. Now, if you look at section 66 of our Act, share is redeemable if the articles of company make provision for the redemption of that share by the company at the option of the company, or at the option of the holder of the share, or on a date specified in the articles. So, there are certain statutory restrictions provided in our law for a consideration that is specified or to be calculated by reference to a formula, or required to be fixed by suitably qualified person who is not associated with or interested in the company, such as a professional like a chartered accountant. They can employ, the company can employ to determine the value that the company may buy back the particular share of the company. A company may exercise an option to redeem a share which is redeemable at the option of the company, if the board has previously resolved that the redemption is in the interest of the company. Now, a company can also determine that for the interest of the company, it is better to reobtain the share that it has given to a certain particular shareholder. Now, these kinds of situations may occur when some person runs into a bankruptcy situation, or when some person is alleged to have committed a fraudulent act, or like such as act of money laundering, so that rather than this particular company runs into a dispute, this company might say, we do not want to take your waste or rubbish, return our share so that we settle you and we buy back the share. In such a situation, then the share can be redeemed. So, this is also allowed statutorily. A redemption of a share at the option of the company is deemed to be an acquisition by the company of the share and a distribution. So, it is an acquisition that the company acquire a share that has been vested upon a shareholder, but this would only apply if that particular share falls within the category of a redeemable share. Then the next category of shares are called the preference or preferential shares. As I mentioned to you, these are kind of privileged shares, preferential shares. Usually have a preferential right to a fixed amount of dividend, that the shareholder has a privilege of obtaining a certain fixed amount of dividend. When the dividend is declared at the end of a financial year, the particular preferential shareholder will obtain a portion of that, because his privilege to own that as a percentage. Generally, they set at percentage, that out of the dividend, the company dividend, the particular preferential shareholder has a percentage, nominal par value of the share. For example, for a 10 rupee share, they can determine 7% preference share is there, so that it will carry a dividend of 7 cents. So, based on the share value, 10 rupees, 7% means 7 cents, sorry 7 cents, not 7 rupees, but 7 cents each year. So, it is fixed, it would not vary on a different percentage wise paid out to ordinary shareholders. They are quite privileged to have a fixed amount of dividend based on the percentage. It is, however, still dividend and payable only out of profits. So, it is only dividend and payable against the profit, The dividend may be cumulative, that is, if not paid 1 year, then accumulates to the next year, or even non-cumulative, so that every year they separate that money and keep it in another account. Either they pay straight away to the preference shareholder, or they keep that money in the account of that particular preference shareholder. The presumption is that it is cumulative. That means there is a presumption that it will add on and go on. But it is up to the company whether to be cumulative or separate each year. The dividend is usually restricted to a fixed amount, as I mentioned. The amount that is agreed on percentage wise generally at the time of issuance of such a preference share. And as I mentioned to you earlier, these preferential shares are provided to a shareholder who has a high caliber and a business tycoon maybe, who this company would like to keep in the company in order to be reputed in the business world. There are some companies that provide such preferential shares to persons of high caliber, so that the company makes sure that their reputation is gained by kind of having this person in the company, high caliber person. Often non-voting, these are non-voting shares anyway, or non-voting except when they are divided in areas. They are sometimes redeemable as well. Sometimes these high caliber people will be given preferential shares, but they will also be informed that these will be redeemable if the company wants to take them back, the shares. They may be given a priority return of capital on a winding up. They may be given a priority over the other shareholders at a time of winding up, when the assets have to be distributed among the shareholders based on the share value. Then the preferential shareholder will top the list, so that the preference shareholder will obtain the first settlement distribution. Then the other categories of shareholding, basically we may come across like two types of shares, such as deferred ordinary shares, that are shares on which no dividend is paid until other classes of shares have received a minimum dividend. Thereafter they will usually be fully participating. And the second type are management shares, a class of shares carrying extra voting rights so as to retain control of the company in particular hands. So, due to the capacity of management of some people, they would be invited to participate in the board like a director. Then they will be offered some shares for doing so. Then we will look at the allotment of shares. So, the allotment of shares, allotment, which means that you allot the shares, allocate the shares to the shareholders. Allotment of shares shall only be made when the amount stated in the prospectus as the minimum amount, which in the opinion of the directors must be raised by the issue of share capital, and the sum payable on the application for the amount so stated, so that the number of shares that are obtained will be so allotted to the shareholder and has been paid and received by the company. When a check for that sum has been received in good faith by the company for the shares, then, and the directors of the company have no reason for suspecting that the check may not be paid, is considered to have fulfilled the payment requirement as well. So, you either pay in cash or you pay by check. So, as long as the check is meant to be genuine in the opinion of the directors or the company, then it can be considered that the shares have been paid, so that the company can allot the shares. Sometimes there may happen situations where company thinking that the payment has come, they do the allotment of shares, but later they get to know that the check is written, and in such a situation then the money has not come to the company. So, allotting of the shares would be problematic in such a case. So, unless a check is like suspicious, when the board or the company considers that it is a kind of a genuine check, there is cash ensured to come to the bank, to the company, then of course the check can be considered as a proper payment. As per section 45(2), where the allotment has not been complied with within the expiration of 60 days from the date of closing of the subscription list, any money received from the applicants for shares shall be forthwith repaid to them without interest. Now, in case that particular interested persons who wants to invest in the company in shares have paid out to the company some money, but they have not been allotted shares by the company, because allotting of the shares of the company is the company's decision. So, if the company has not allotted, within 60 days of accepting that money, the company should return the money. And directors are jointly and severally liable if fail to do so, failing to return the money, unless it can be proved of no misconduct or negligence caused on his or her, the director's side. Otherwise, the directors are liable. In the case of Hilder versus Dexter, this is a British case. In order to raise working capital, United Gold Coast Mining Properties Limited offers shares at par value to Mr. Hilder and others with an option to take further shares at par for 2 years. After share price rose, Mr. Hilder wished to exercise his option. It held that Hilder was entitled to exercise the option as it in no way directly or indirectly contravened the rule against issuing shares at a discount under Companies Act in England. In the case of In Re Rag Limited, Mr. Ragg and Mr. Martin sold their omnibus and livery stable business to a newly incorporated company for £46,300. The company paid by issuing debentures and fully paid shares to Mr. Ragg and Mr. Martin. The liquidator of Ragg Limited claimed that the company was, in return for the share issue, worth £18,000 less than the board had decided to pay. Linley Lord Justice in House of Lords held that the transaction was wholly legitimate and decided that shares cannot be issued at a discount or below their nominal value, and continued. He further stated that it has, however, never yet been decided that a limited company cannot buy property or pay for services at any price it thinks proper and pay for them in fully paid up shares, provided a limited company does so honestly and not colorably, and provided that it has not been so imposed upon as to be entitled to be relieved from its bargain. It appears to be settled that agreements by limited companies to pay for property and services in paid up shares are valid and binding on the companies and their creditors. It is not law that persons cannot sell property to a limited company for fully paid shares and make profit by transaction. We must not allow ourselves to be misled by talking of value. The value paid to the company is measured by the price at which the company agrees to buy what it thinks it worth its while to acquire. Whilst the transaction is unimpeached, this is the only value to be considered. So you can see how certain cases have dealt with the allotment of shares in a company. Now, I would like to look at an exercise. There are two tasks that I have given. In the task 1, someone who is operating a sole proprietorship business of producing and selling timber materials for the construction industry has seen the growth of his business over the last 10 years to unprecedented levels, making huge profits. Since the revenue tax liability accruing to him personally at escalating levels each year, He is afraid that his family will have to bear the tax burden in case of any sudden illness or death of him. Therefore, he intends to incorporate a private company for his business and divert it on a limited liability scenario. Advise someone. Now, this particular example or the task is pretty much similar to what happened in Solomon versus Solomon and Company Limited case. Though the task does not go to the end of a company, but what you have been asked to do is to advise someone on how to incorporate a company. So what you need to do is, you need to first of all explain someone. Now the difference between a sole proprietorship and a company, as I have already explained to you all, what you need to do is to explain the business of a sole proprietorship and the business of a company, and how the legal personalities differ, and what are the advantages and disadvantages between a sole proprietorship and a company. And thereafter, how to incorporate that company under the law of Sri Lanka, what we have discussed. So you got to deal with both these elements, showing someone what sort of a thing is a sole proprietorship and what sort of a thing is a company, and that what benefit that someone can obtain by incorporating a company. You know that sole proprietorship is quite personal, where a company is a legal person itself. Now suppose that someone dies, or someone, like here says, falls into a illness. It will be very difficult to run that business, I mean not physically but legally, because everything is in someone's name. If someone dies, he has to be replaced by the family as a successor, as successors. In the company, you don't have to do that. Someone can have the shares, then the company can still exist even though someone dies. I told you the other day that king is dead, long live the king, same as the theory in company law. So therefore, someone will be more benefited by having a company, so that in a case of a sudden ill or death that he fears, the business will be secured, and it's just a matter of appointing the successors with respect to the shares that someone holds in the company. So this is how you need to give the advice. Then in task 2, the shareholding of XYZ Private Limited is considered of both redeemable and ordinary shares. Further, the company had contracted in writing with the creditor by agreeing that the company will not reduce its share capital more than 5% without the prior consent of the creditor. Now you are required to advise on two things: the procedure of redemption of redeemable share. What is the statutory provision that deals with the redemption of redeemable shares? How to reobtain the shares? What is the statutory provision? And secondly, the procedure of reduction of share capital. How to reduce the share capital? Now here, in answering, I would like to show you here the statutory procedure as in our law on the redemption of shares. As per section 67 of the Companies Act, a company may exercise an option to redeem share which is redeemable at the option of the company, if the board has previously resolved that the redemption is in the interest of the company. That's the basis on which the board can consider. Then a redemption of share at the option of the company is deemed to be an acquisition by the company of the share, reobtained, for the purpose of subsection 3 of section 64 and subsection B, distribution for the purpose of section 56. Under section 68, where a share is redeemable at the option of the holder of the share and the holder gives proper notice to the company, like take my shares back, to the company requiring the company to redeem the share, the company shall redeem the share on the date specified in the notice, or if no date is specified, on the date of receipt of the notice. The share is deemed to be cancelled on the date of redemption, and from the date of redemption, the former shareholder ranks as an unsecured creditor of the company for the sum payable on redemption. So that which means that the company has to pay him back the money, take the share back by the company, and the company pay back the money to the redeemable or the redeemed shareholder. A redemption under this section is not a distribution for the purposes of section 56, but is deemed to be a distribution for the purpose of subsection 1 and subsection 3 of section 61. Under section 69, where a share is redeemable on a specified date, then the company shall redeem the share on that date. The share is deemed to be cancelled on that date because that's the deadline, and from that date the former shareholder ranks as an unsecured creditor until the settlement for his redeemed share for the sum payable on redemption. And a redemption under this section is not a distribution for the purpose of section 56, but is deemed to be a distribution for the purpose of subsection 1 and subsection 3 of section 61. Now this is how you have to answer that particular task, because you have to give the proper statutory requirement of redeeming the share in whatever the circumstances that it can happen. Then the next one, procedure of reduction of share capital or the stated capital. How to reduce the share capital? Under section 59, subject to the provisions of subsection 3 of this section 59, what we will be reading through later, a company may by special resolution, this is very important, special resolution, reduce its stated capital to such amount as it thinks appropriate in accordance with the provisions of this Act. Public notice of a proposed reduction of a company's stated capital shall be given not less than 60 days before the resolution to reduce stated capital is passed. Then a company may agree in writing with the creditor of the company that it will not reduce its stated capital below a specified amount, like in the question below 5%, without prior consent of the creditor or unless specified conditions are satisfied at the time of the reduction. A resolution to reduce stated capital passed in breach of any such agreement shall be invalid and of no effect. Where a share is redeemed at the option of the shareholder under section 68 on a fixed date under section 69, what we discussed previously, or the company purchases a share under section 95 and the board is satisfied that the consequence of a redemption or purchase, the company would, but for this subsection, fail to satisfy the solvency test in the sense the capacity, performance, and how solvent the company is, right? That we will be dealing with solvency tests in a later lecture. The board shall, after obtaining the auditor's certificate of solvency, how competent financially competent the company is, resolve that the stated capital of the company shall be reduced by the amount by which the company would so fail to satisfy the insolvency test, and the resolution of the board shall have effect notwithstanding provisions contained in subsection 1 to subsection 3 of the section. A company which has reduced its stated capital shall within 10 working days of such reduction give notice of the reduction to the registrar ROC, specifying the amount of the reduction and the reduced amount of its stated capital. Where a company fails to comply with requirements of subsection 2 and subsection 5 or subsection 5, a company shall be guilty of an offence and be liable on conviction to a fine not exceeding 50,000 rupees, and every officer of the company who is in default shall be guilty of an offence and be liable on conviction to a fine not exceeding 50,000 rupees. So, which means that the company, if the company does not follow that procedure, the company is at fault, company is liable for a fine as penalty. Not only the company but also the officers, the human element like the directors are so liable separately from the company. So, you see, when answering you need to give proper clarification like this. Now, in case that you cannot write all these things or memorize all these things, the best thing for you is to have a short note and study on what steps that need to be done with respect to these kinds of scenario, redemption and reduction of stated capital. So, while keeping the next topic, veil of incorporation, to be discussed on the next day, I would like to end today's lecture at this moment, and I hope and I wish that all my students have gathered the necessary knowledge in the areas that we covered, and make sure that these areas that I have covered are the specially selected areas from which you are going to get questions for the examination. And even the lectures that I am going to continue in the future are the ones that your examination paper will be based. So, thank you very much for listening, and we will meet up on the next day with CL4 Corporate Law lecture.